U.S. government debt is now the highest in history.
In recent weeks, the US government has reported an alarming figure, a $1.1 trillion deficit in the past 5 months. This marks the highest deficit in US history.
That people who worry about the debt and the deficit like to focus on the most, or they see as one of the biggest problems.
Surpassing even the massive borrowing during the pandemic. In this video, we will explore why America's budget deficit is growing, what it means for the economy, and whether the US is heading toward a full-blown debt crisis. Let's dive into the fiscal situation and the implications for the future of the country's finances. The United States have been running budget deficits for decades, but it wasn't always this way. The last time the US government ran a surplus was in 2001 under President Bill Clinton. Since then, deficits have become a regular part of the country's fiscal policy, with each administration contributing to the growing national debt. In recent years, the deficit has expanded, especially under the Biden administration. After the pandemic, the deficit dropped from 12% to 5% of GDP, but it's expected to rise again, reaching over 6% in 2023 and 2024. This is significant because the US is now running one of the most enormous deficits in the OECD, only surpassed by Israel. For comparison, the Eurozone's average deficit is around 2%, and advanced economies typically run deficits of 2 to 3%. The widening gap between government spending and revenue is putting increasing pressure on the US economy, raising concerns about long-term fiscal sustainability. Now, when Donald Trump took office, the US was already facing a challenging fiscal landscape. Despite this, Trump's administration introduced significant tax cuts without offsetting spending cuts. The tax cuts were designed to stimulate the economy, but they only worsened the deficit without reducing government expenditure. Trump also made it clear that he would not touch key social programs like Social Security, Medicare, or Medicaid, which are major contributors to federal spending. These decisions increased borrowing and pushed the deficit higher. Additionally, the lack of comprehensive budget reforms meant the government spending remained unchecked. Another factor was Trump's creation of the Department of Government Efficiency, or DOGE, which was supposed to save the government $2 trillion by rooting out waste. However, the results have been underwhelming, with DOGE only saving a few $billions to date. As a result, the deficit continued to grow, and Trump's fiscal policies contributed to the mounting national debt, making it harder to reverse the trend of increasing borrowing. The latest figures from the US Treasury Department are alarming. In February alone, the US ran a $37 billion deficit, with $63 billion in spending and $296 billion in tax receipts. This means the government borrowed more than it collected in taxes. Looking at the first 5 months of the fiscal year, the government has ran a staggering $1.15 trillion deficit, approximately $8 billion per day. This is 177% higher than the same period last year and marks the highest deficit ever recorded, surpassing even the pandemic-related borrowing of 2020 and 2021. These figures highlighting the deepening fiscal crisis that both parties must address. This issue is not just the result of the Biden administration policies, it's Trump's tax cuts and lack of spending reforms continue to impact the country's fiscal health. His proposed $4.5 trillion tax cuts over the next decade would only add to the budget gap. Despite claims of $2 trillion in savings, many of these cuts are expected to be offset by spending increases, particularly in areas like border security and defense. The US economy is facing a potential slowdown, which could significantly impact the budget. A slower economy means fewer people working and paying taxes, leading to lower tax receipts. At the same time, higher unemployment and economic hardship could lead to more people relying on government assistance, such as unemployment benefits and food assistance. This combination would increase government spending and put further strain on the budget. Furthermore, reduced business activity may lead to lower corporate tax revenues, adding to the budget shortfall. Now, while the Federal Reserve may lower interest rates to stimulate the economy, this is a modest silver lining. Lower interest rates could reduce the cost of servicing the national debt, but it will not be enough to offset the massive deficit. The more significant challenges lies in the long-term sustainability of this approach, as continued borrowing could lead to higher debt servicing costs down the line. Various solutions have been proposed to address the growing deficit, including cutting government spending and reforming tax policies. However, these solutions face significant challenges. Politicians are often unwilling to make tough choices, particularly when it comes to cutting popular social programs like Social Security and Medicare. Public resistance to these cuts is strong, making it challenging to balance the budget. On the revenue side, proposals to increase taxes have also faced opposition, especially from those who argue that tax hikes could hurt economic growth. Another issue is the recent push to reduce the size of the IRS. Trump's administration and Dodge proposed cutting thousands of IRS employees, which could further limit the government's ability to collect taxes efficiently. The IRS is known to be highly effective in generating revenue, and cutting staff could reduce the government's ability to collect much needed tax income. The US is now carrying a massive debt, and the costs of servicing that debt are increasing. Debt servicing alone has cost the US nearly $500 billion in the first 5 months of 2024, and this figure is expected to rise significantly in the coming years. The risk is that the US could enter a debt spiral where it has to borrow more just to pay the interest on its existing debt. This would lead to an unstable increase in national debt, which could destabilize the country's finance. Another concern is the US dollar's role as the world's reserve currency. The US can borrow so much because its treasury bonds are considered the safest investment in the world. However, if global investors start losing confidence in the US economy, they may look to other bonds, such as those issued by Germany or China. This shift could weaken the demand of US debt and make it more difficult for the US to finance its deficit. A loss of confidence in the US dollar could trigger a broader financial crisis affecting global markets. The US is currently facing a massive fiscal challenge, with the deficit and national debt reaching unpredictable levels. While it's uncertain whether America is on the verge of a full-blown debt crisis, the signs, well, they're just concerning. The combination of rising debt servicing costs and slower economy and an over-reliance on borrowing could lead to long-term fiscal instability. Without significant changes to spending and revenue policies, the US risks facing severe consequences in the future. The question remains, can the US get its finances back on track before it's too late? Or are we heading for a crisis that could reshape the global economy?